Hello and welcome to Numero Analytics webinar on China and commodity markets. I'm Matthew Lapointe and I'm joined today by Joaquin Kritz-Lara, Numero's Chief Economist and Strategist. In today's webinar, Joaquin will discuss the factors behind China's economic slowdown and implications for global commodity markets in 2022. Using the Q&A feature, we encourage you to write any questions you may have and we'll try to address them at the end of the session. Also, note that later today, we will send you a copy of the slide deck as well as a recording for the webcast. However, before we dive in, I'd like to give you a brief overview of Numero's macro research practice. Our macro research practice offers economic research and strategy services to multinational and institutional investors. Unlike conventional macro shops, we don't just focus on central scenarios, but rely on cutting-edge probability forecast models to help our clients monitor the various risks affecting their businesses and investments. By evaluating the full range of potential outcomes, we are much better suited at anticipating scenarios downplayed by most economists and investors. Consider, for example, our oil call from September 2020. At the time, our models revealed a very high probability of prices rising above $80 per barrel by October 2021. Although this was much different from what financial markets were expecting, as many forecasters were predicting for oil to remain below $50. Fast forward 1 year, as you can see by the yellow line, not only were we correct in our prediction for oil prices, but our models predicted the price almost to the exact number. All this to say, our models give us the tools to anticipate changes in concepts that are notoriously difficult to anticipate with standard forecasting methods. Within the corporate space, we can help all divisions of the company, but in particular, we can help sales, treasury, and finance divisions. For example, our research helps users identify opportunities for growth and better understand the various macro trends shaping pricing and cost dynamics. By monitoring and quantifying risk to the economy, we can also help Treasury and Finance improve the macro assumptions underlying their financial projections, and even improve their hedging strategies. Numeric clients receive over 100 research reports per year, covering multiple economic and investment themes. We draw information from our proprietary models to provide forecasts on all major asset classes such as equities, bonds, commodities, and foreign exchange. And finally, I wanted to show you the faces behind the research that we produce. Here is our macro services team. Our macro service team now includes accomplished economists and strategists based in Montreal and now in our Latin American office in Buenos Aires. And now I'm going to pass on to Joaquin, who will discuss our latest views on China's economic slowdown and how it will affect the global market. Joaquin?
Thank you, Matt. So as Matt explained in the introduction, we're going to focus on two key themes in today's presentation. The first part of the presentation, I'm going to dedicate it on China and talk about our views on China's economy in 2022 and beyond, and discuss some of the various risks that are shaping China's growth outlook and its implications for other countries and regions of the world. And then in the second part of the presentation, I'll draw on the insights that we discuss on China and give you an overview of our latest views on commodity markets and what we think will happen to commodity prices at large over the coming year. So starting off with China, I think what's important to consider is that China and the rest of the world have had essentially recoveries at different speeds. If you remember, in the second quarter of last year, China rebounded much faster than the rest of the world from the initial COVID shock. This was a consequence of various factors, including certainly macroeconomic stimulus by Beijing, in the form of higher credit growth and infrastructure spending, for example, but also benefiting from the fact that a reduction in mobility essentially shifted expenditures in developed markets towards goods and away from services, and this benefited China directly because, factories in China account for something like 25% of global manufacturing, and so the country was much better suited to react to this initial increase in public health risks. Now, if you fast forward 1 year, what's happened is that this initial V-shaped recovery has essentially faded, and the economy is now essentially has lost all momentum. So what you're able to see in the chart in front of you here is the evolution of global GDP by region in the second and in the third quarter of this year. The second quarter is noted by the little red dots, and then the bars correspond to the estimated or reported growth rates for the third quarter worldwide. Now, notice that the global economy in the third quarter continued to grow above potential. We're estimating that growth worldwide was around 6% annualized, which is not only faster than what we saw in the second quarter, but also well above the global economy's potential or trend rate of growth, which is around 3%. So we continue to see, an improvement and a reversal back to the pre-COVID trend on a global basis. Now, what's interesting about this is that the bulk of the growth stemmed from regions other than the US and China, which are typically the main contributors to global GDP growth just by sheer size. If you focus on China in particular, quarter-on-quarter growth was nearly flat. The country posted an annualized growth of less than 1%, which is certainly extremely, if you look at the performance of China's economy in the last 2 or 3 decades, this is an extreme outlier. What I think is important here to note also is that excluding the third quarter of last year, when you had a sharp rebound in activity in developed markets from the Q2 slump, so if you exclude that quarter, this is the first time since 1995, I believe, that China's economy posts a weaker pace of growth than developed markets on a quarter-on-quarter basis. So we're in fairly unique times. Now, there's essentially 2 main factors behind China's slowdown. The first of these, probably the most important one for longer-term growth prospects, has to do with Beijing's increasing emphasis on financial stability. Now, typically, in the last 2 decades or so, China has relied very heavily on investment spending and credit growth to fuel economic activity, especially since 2008, 2009. It went back to these policy methods early in the pandemic, but that has essentially resulted in a significant amount of leverage in the corporate space, in particular in its property sector, which is exceptionally leveraged. And so, because of the government's concern on over-indebtedness in the real estate sector, they've started earlier this year to cut back on credit to these segments and also impose rules on property developers like China Evergrande, as I'm sure you've seen on the news, to limit the amount of borrowing that they can access. This has the effect of this has been essentially to cool off the housing market, resulting in a steep decline in both housing starts and residential property sales. You can see this illustrated in the chart, in this chart in front of you. This tracks building starts in China since 2007 against real property sales. Now, if you focus on the right end of these series, you'll see that both of these segments are actually experiencing declines after rebounding rapidly in the second half of last year. Since April of this year, building starts, for instance, are down something like 25%, which is having a very significant knock-on effect on industries that rely on housing construction very directly as a source of revenue, such as cement, for example, or the lumber sector, for instance, would also be heavily affected by this. Now, the other key source of weakness that we've seen in the third quarter is related to power shortages. Historically, China has, I'd say really over the last 5 years or so, Beijing has been increasingly forcing the shutdown of small, mostly private coal mines for environmental reasons, but it continued to rely heavily on coal in general as a major source of power for its manufacturing base. Starting last year, however, because of geopolitical reasons, they imposed an unofficial ban on the import of coal from Australia, which started to result in shortages, in electricity shortages, and this problem essentially accentuated in the third quarter of this year as Beijing started to impose restrictions on coal miners and utility providers to mitigate the degree of greenhouse gas emissions to meet their CO2 targets. And so the effect of this has been for the price of coal and electricity to increase very rapidly, and this has had a very pronounced impact on heavy industry. One sector that has been very heavily affected, for instance, is steel. China's steel sector is the main user of energy in China, and this is because steel makers rely on, obviously, on electricity for power, but they also use coal, or in the case of steel, it would be called metallurgical coke, as a raw material for the production of steel, so for transforming iron ore into steel. And so with coal and coke prices rising, factories have had no other option but to actually shut down capacity. Steel production in China, which is historically a key contributing factor to industrial activity in the country, has declined 20% in the second half of the year, which has obviously weighed down heavily on industrial activity at large. Now, will this weakness continue or not? In the very near term, we can look at leading indicators to have a sense of whether economic activity will recover or continue growing below potential. The chart that you see in front of you here shows our leading activity index for China. Now, this is a proprietary index that we derive internally. The idea is to have a proxy measure of China's business cycle that condenses information from a large number of sources. So this could include electricity generation, ocean freight or inland freight, for example. It could include cement production, as well as various business surveys that capture the degree of sentiment by factories and the service sector at large. And so what the index shows you essentially is the common movement across a large panel of indicators, which is again meant to proxy the state of China's business cycle. When the index exceeds 0, then that means that the economy is undergoing a cyclical upswing, or it's essentially growing strongly versus its trend. Whereas when it falls below 0, the reverse is the case. Now, as you can see from the chart, following a steep drop in activity in January and February of last year, the economy rebounded very rapidly. In fact, growing above potential through much of the second half of last year. But there's now considerable weakness at play, with this leading activity indicator pointing to very weak growth as well in the fourth quarter. What this translates is, so in terms of GDP growth, this translates into below potential growth in 2022. The chart that you see here is our latest update for GDP growth in China for full year 2022. As Matt discussed, the work that we do on the macro side in Numera is typically probabilistic in nature. So we don't just focus on the central scenario, but evaluate the full range of potential outcomes. Now, so this is basically the probability forecast for Chinese GDP growth in 2022. The most likely outcome, which is the mean of this distribution, or the equivalent of what a point forecast would be for most professional forecasters, is for the economy to expand 5.5%, which is lower than the country's potential rate of growth. Now, in probability terms, though, it's not impossible for the economy to grow above potential, but that probability, which is highlighted by the shaded red area, is less than 40%, which is low by historical standards. So what our modeling work is telling us, again, taking into consideration these recent market dynamics and the ongoing housing slowdown, is that in probability, the economy will grow below its potential next year. Now, the key source of weakness, even in 2022, in our view, is the housing market. Now, just to give you a better sense of the importance that construction and real estate have for China, this chart basically compares the importance of construction and real estate in China's economy as a share of GDP compared to other major economies in the world. So the light green dots would be emerging economies, and the blue dots would be developed market economies. And then on the horizontal axis, this compares to the weight of contact services, so things like recreation services, hotels, that sort of thing. So basically, segments that are directly impacted by COVID. And you can see that the structure of China's economy is very, very different from that of other countries in the world, including both developed and emerging economies. The more important feature of this chart is that it highlights the importance played by construction real estate. Both of those segments contribute more than 1/4 of China's GDP in level, and the contribution on China's growth rate over the last two decades really has been even bigger than that. And this is very different from most other economies in the world. And then conversely, the service sector in China is really quite small. And so if we expect an improvement in mobility through declining public health risks because of, say, a higher vaccine coverage, yes, that's going to benefit China, and it'll provide some degree of impulse for economic activity in 2022, but nowhere near the same type of impulse that you would find for other regions of the world, again, including both developed and emerging economies. And then conversely, if Beijing decides to essentially cut back credit permanently to the property sector, then it becomes extremely unlikely that the economy will be able to support the types of growth rates that we've become accustomed to seeing in China over the last five decades. Now, what's really important to over the last 2 decades, excuse me, what's really important to understand here is that the role that construction and real estate play on China, it doesn't only affect, you know, near-term growth prospects, but it has implications for the country's trend rate of growth. Now, I find this chart to be particularly revealing. What it does is it compares the evolution of fixed investments. So this would be investment in structures and equipment, including buildings, for example, as a share of GDP for China, that would be the red line, and other countries in the world. So the blue line is for the world as a whole, then the green line is for Japan, and then the gray line is for Korea. Now, what you can see basically is that China, really since the early 1980s, which is when they started the modernization campaigns under Deng Xiaoping, China's reliance on investment spending, including residential construction, as a source of growth has been exceptionally high, and this continues to this day. In 2019, which is the latest data point that we have for this chart, fixed investment accounted for 43% of GDP in China compared to 26% for the world as a whole. And so if the real estate sector is to slow down permanently, then it becomes very difficult for China to be able to support the kinds of growth rates that we're used to seeing. And this is not an experience that is exclusive to China. It's not the first time in history this would happen. The reason why we're showing Korea and Japan, excuse me, is because both of those economies underwent similar dynamics, but earlier in their development process. Japan, for instance, essentially Japan's capital stock, so its stock of factories, of buildings, and so on, following World War II, obviously got depleted. And then the country experienced 3 or 4 decades of very, very strong growth, fueled by remarkably strong growth in fixed investment. And that essentially lasted until the mid-1980s. And then as the country transitioned and became essentially an advanced economy with high per capita incomes, then it became increasingly difficult for growth in things like machinery, equipment, construction, and so on to continue supporting the pace of growth that Japan was used to seeing, and investment essentially became much less important. A similar pattern occurred to Korea, although not to the similar extent. And if this same transition were to occur in China, and this is what this is like a typical middle income transition, if you will. If this were to happen, the only way for China to support the rates of growth we're used to seeing is for productivity growth to expand. And this is not impossible, but it's a very difficult challenge for Beijing. Now, typically China has relied on high productivity, which stems from things like low energy costs and low labor costs, which have given the country a lot of external competitiveness over time. Now, as per capita incomes in China rise, they don't really have that source of growth as a support. So they either have to rely on technology transfers through foreign investment, for instance, or by a rapid transition towards high productivity areas of the economy, like, for instance, renewables or electric vehicles, for instance. The issue is that these segments are still in their infancy, and they represent a very small share of GDP. And in addition to that, there's a lot of regulatory pressure on foreign corporations and even Chinese companies that are trading in offshore markets, which is essentially dissuading the degree of foreign investment that is entering the economy. You can see this in the chart that I'm showing here. This shows foreign direct investment. So this would be investment, say, via joint ventures in China's economy by foreign companies as a share of GDP. In the 90s and even in the early 2000s, following China's entry into the WTO, foreign investment was a major source of growth to China, both directly and indirectly by fueling productivity growth through technology transfer. That is increasingly less so the case. And if these regulatory pressures continue, then it's going to become less and less likely for China to be able to rely on this. And so what follows naturally from this is that it's going to be virtually impossible for the country to support the kinds of growth rates that, again, we've been used to seeing in the last 2 decades. Now, in terms of what I think is also really important is not just China's growth rate in absolute terms, but also how the country's performance compares to other regions of the world. What you see in front of you here is global GDP growth. So these are baseline scenarios for global GDP growth in China next year, compared to potential rates of growth for various different economies. So for example, given what we know today, the most likely outcome is for GDP worldwide to grow 4% next year, which exceeds the little yellow dot, which is the potential rate of growth, which means that economic activity worldwide will continue to recover and sort of move closer towards its pre-COVID trend or pre-COVID path. Now, what's interesting is that most of that improvement, as you can see, stems from developed markets, which should continue growing well above potential next year, particularly in the euro area, which is benefiting from, well, it'll partly benefit from favorable base effects because the euro area did have a technical recession in Q1 of this year, but also from high vaccination rates and much stronger confidence than in other, much stronger consumer and business confidence than in other economies. Now, conversely, if you look at China, China's economy will likely grow below potential. And what's important to consider here is that the growth premium that China has with the rest of the world will obviously continue, but it will narrow versus, again, what we're used to seeing. Now, in terms of international spillover effects, so how does this slowdown affect other regions? The impact varies considerably by region. One way to gauge this is by looking at the importance of China as an export market for various different countries in the world. So this is exactly what this chart shows you here. This shows merchandise exports to China by region as a share of overall export revenues, broken down by type. So the light blue bars, for instance, correspond to intermediate goods, which would include commodities and semi-processed goods. So, for instance, pulp would fall under that category. And then the yellow bars and the dark blue bars would correspond to finished goods, either consumer goods like electronics, for instance, or investment goods like machinery, say, shipped from Germany. What's interesting is that the direct exposure to China varies enormously by segment. Oceania, for instance, is very, very heavily exposed to China as a major source of export revenues, Australia is one of the world's leading exporters of iron ore and coal, for instance, and China is by far its main export market. And so if China's pace of growth were to weaken in combination with geopolitical tensions between Canberra and Beijing, that means that demand or the outlook for that particular region is exposed to bigger tail risks than for, say, North America or Western Europe that have a very limited direct exposure. Now, moving on to commodity markets, before I discuss what China's long-term growth slowdown means for commodities, I did want to offer you like a very brief overview of what we've actually seen in commodity markets this year. As one would have expected from past reflationary global macro regimes, so conditions in which growth grows above potential and inflation starts rising, commodities have in fact outperformed most other asset classes so far this year. The chart in front of you here compares the evolution of broad commodity investments, so this would include investments in energy and non-energy commodities, versus returns on developed market stocks, so the S&P, for instance, or the European equities, and emerging market equities. And commodity markets have done very strongly this year. If you had invested in, say, commodity indices earlier this year, at the beginning of this year, you would have made nominal returns of around 40%, which is nearly double than what you would have made in investing in developed market equities, and clearly a lot more than if you had invested in emerging market assets. What's interesting about this, though, is that the commodity bull run has been very uneven, and it has essentially been driven by very, very strong growth in oil and gas prices, which by revenue are by far the biggest commodity markets. One interesting dynamic I find is that what we've seen is a decoupling between commodity prices, with energy performing very strongly and other segments, especially those directly exposed to China, doing less well. The blue line in this chart, for instance, shows the ratio of energy to metal prices in the S&P's benchmark commodity index and its evolution since January of this year. It's gone up, and the implications of this is that not only obviously have energy exporting regions benefited directly from this, but we've also seen a rotation in terms of the performance of asset classes that are directly exposed to this. In the currency space, for instance, the fact that energy prices started rising very sharply and metal prices weren't doing as well because of this direct exposure to China meant that petro currencies, like, say, the Canadian dollar or the Russian ruble, appreciated in value versus, for example, Latin American currencies, which are proportionately more exposed to China and less dependent, if you will, on oil and gas as a major source of revenue. So, for instance, as the ratio of energy to metal prices rose, the ruble, for example, gained considerable ground against the Chilean peso, which is given Chile's very heavy dependence on copper or copper ore as a source of export revenues, weakened considerably, also amplified by political instability in Chile, but certainly China's slowdown has played a role there. And we've seen similar dynamics if you compared, say, Canadian equities against the Australian dollar, for example, or developed market currencies against, say, the Brazilian real. We've seen very similar dynamics there. Now, what is really important to understand here is, as I mentioned before, in a context in which global demand for commodities has started to weaken because of China's slowdown, a lot of the improvement we've seen, especially in the second half of this year, stems from very tight production of oil and natural gas. For example, the chart that you see in front of you here shows the difference between crude oil production worldwide today and its pre-COVID path. So this is what we would call the oil production shortfall. So right now, essentially, what this is telling you is that global oil producers are supplying something like 6 million barrels less than they would have absent the COVID-19 pandemic. If you break that down by region, what's interesting is that the bulk of that tightness is stemming essentially from very low supply in the United States by shale producers who are essentially prioritizing cash flow over oil well drilling, which is what they did, for instance, in the aftermath of the Great Recession, eventually resulting in a collapse in oil prices. So they're trying to avoid that experience, and that's holding back supply considerably. Europe is experiencing similar difficulties in sourcing natural gas because of a lack of domestic availability, but also because of geopolitical tensions in this case with Russia. And another important aspect beyond tight supply that I think is worth considering is the role played by investor sentiment. Now, commodity prices are fairly unique compared to other goods markets in the sense that pricing dynamics depend as much on financial market developments than they do in changes in physical demand and supply. So in the case of oil, for instance, which is by far the world's most traded commodity, bullish or bearish sentiment by oil traders can have a very pronounced impact on spot prices, irrespective of what actually happens to the physical market balance. What we've seen in the second half of this year is for sentiment to turn very bullish. So basically, oil traders expecting prices to go up further and then essentially playing the market or playing the market in response to that, which is creating demand for oil in, say, futures markets and options markets. And this is actually accentuating the role played by physical supply. You can see this in the chart shown in front of you here, which is what is known as the put-call ratio on crude oil options. Now, if you have some experience in trading options, say for hedging strategies, for example, a put option basically is a bet on prices declining over a particular forecast horizon, whereas a call option is a bet on prices increasing. So if the put-call ratio falls, then that means that there's proportionally more traders betting on prices going up and less traders betting on prices going down. Typically, that ratio is around 1. So there's roughly the same amount of people betting on prices going up than prices going down. But today, the put-call ratio is extremely low by historical standards, suggesting that a lot of the increase that we've seen in pricing in the last few months, especially since the second half of this year, is actually sentiment related and probably therefore transitory in nature. So obviously, if sentiment were to normalize, then that's going to have a knock-on effect on energy prices, which our modeling work actually reveals are now trading above fair value. So basically the price supported by market fundamentals. If you're looking at, say, 1 year into the future, the outlook also depends very heavily on China. The chart that you see in front of you here, these are two proprietary indices that we track. The first one, which is the one in blue, is the leading activity index I showed you before, and then overlaid on top of that is our measure of commodity demand worldwide. It's the same type of concept where if the index is positive and rising, that means that demand for commodities is improving worldwide, and then if it's declining, then that means that commodity demand is weakening. And clearly, what we've seen historically, as you can see, there's a very, very tight link between both of these indices. And so what this is telling us is that if we think that China's economy will weaken next year and even beyond, then the upside on commodity prices or commodity investments is weaker than it would be in a situation in which commodity demand is rising considerably. And so when you map this into price forecasting models, what you find is that the upside for commodities, which as the chart that we showed you in oil, that Matt showed you in oil at the beginning of the presentation, last year there was a lot of upside for commodities because, physical market balances, so the balance between demand and supply in most industrial commodity segments was very favorable, and there was not really the same type of buildup of bullish sentiment that what we're seeing today. The combination of both of those factors means that it's unlikely for the commodity bull run to continue over the coming year. In fact, the most likely outcome is for commodity prices in real terms to turn slightly negative next year, to yield slightly negative returns. I would say that the most important factor behind this is China's slowdown. One additional factor that I would consider in shaping your views on commodities in 2022 is the role played by the US dollar. Historically, as you can see here, there is a very strong inverse link between commodity prices, here shown in red, and the US dollar in trade-weighted terms. The reason for this is that commodities are traded internationally in US dollars, and so if the dollar appreciates in value, then that typically means that the dollar price of commodities will decline. And also, if the dollar strengthens in value, commodity importers will find it more expensive, basically, to purchase commodities. And so typically this causes physical demand for commodities to also weaken. One aspect that's being discussed in the financial press a lot these days is the role played by reduced stimulus by central banks in developed markets. As you may have seen, the Federal Reserve has announced that it's going to end its unconventional policy support for the U.S. economy by basically cutting back what the financial press refers to as quantitative easing, which are basically large-scale bond purchases. This is not the first time this has happened. There's one previous experience in 2013 when the Fed under Bernanke as chairman essentially announced a taper, and the consequence of that was essentially financial markets at the time kind of panicked because of this, because they expected less policy support. And what happened was that there was flight to safety effects at play, basically increasing demand for safe haven assets like the US dollar, which caused commodity prices to weaken somewhat. The effect wasn't especially pronounced, certainly not compared to large commodity swings, but it did play a modest role in driving down commodities, and this is something we would probably expect would happen again in 2022. And then the final point that I want to raise in the presentation is that while China's slowdown is detrimental to commodities at large, not every market is equally exposed. One way to look at this is, for example, by evaluating the performance of commodity prices or commodity inflation by sector when China's economy is growing above and below potential. So the green bars here shows you the average return that you make on commodity investments by sector when China's economy grows above potential. So this is historically. So the average return commodity prices made since the early 90s in periods in which China was growing above potential. So typically the performance of commodity markets is very strong in this environment. There's usually double-digit gains for most major asset classes, but you'll notice that the difference varies considerably. By far the biggest exposure is on industrial metals like copper and iron ore. So historically, in periods in which China grows above potential, copper prices rise over 20% over a one-year period. Iron ore also rises something like 20%. Whereas in periods in which China's economy grows below potential, like we expect will happen next year, then the effect is quite detrimental. And the reason for this is twofold. The reason for this really is that China represents something like 55 to 60% of global demand for metals, whereas the impact, the exposure of other commodity markets like energy, for instance, is nowhere near as high. And so this mitigates the effect. One important consequence right now is that we think that a lot of the slowdown that we'll see next year will stem from housing activity, which is the biggest end use market for both copper and iron ore. Iron ore prices have already declined sharply because of this steep decline in steel, which has reduced iron ore demand, but we haven't really seen that for copper yet. And then the final slide that I want to share with you here is our latest projections for copper prices over the coming year. So this is for the spot LME price, which is the global benchmark for refined copper. Copper right now, so refined copper at the LME is trading around $9,900 per metric ton, which is extremely high by historical standards. What our modeling work is telling us is that given the direction in which China's economy is heading, there's only a 24% chance that prices will either remain or exceed that level 1 year into the future. The most likely outcome is for prices to drop well over $1,000 per metric ton. And so this has obviously very detrimental consequences to commodity exporters, but also weakens, for instance, LATAM currencies versus both developed market currencies as well as other asset classes. So with this, I'm wrapping up my portion of the presentation. I think we have a few minutes for questions, so I'll pass it on to Matt to see if there's any questions from the audience.
All right, well, thank you, Joaquin. So now we do have a couple questions from the audience. So the first one we have is, how will China's growth slowdown affect the global inflation outlook?
Yes, so that's a very good question. Obviously, inflation has been a key macro theme this year. I would argue that the impact that China can have on global inflation occurs through two key channels. The first one, which we just discussed, is the commodity channel. Obviously, China has a big impact on commodity prices, and commodity prices can feed directly into global inflation, both by affecting producer prices, but also in the case of, say, energy, they enter directly into consumer baskets and therefore affect consumer inflation more directly. Now, in the case of commodities or the commodity channel, obviously, if China's economy slows down and commodity inflation weakens, then that's going to limit a little bit the rates of inflation we've seen this year. But one caveat to consider here is that China's importance in energy markets is nowhere near as pronounced as it is for, say, other industrial commodities like metals. And energy, oil in particular, is the commodity that has the biggest impact on inflation. And so to the extent that you think that oil prices will not decline as much as, say, metals or grains, then that shouldn't have that much of an impact on global inflation as one would otherwise expect. And then the other important channel is through producer price inflation directly. As I mentioned at the beginning of the presentation, China represents something like 25% of global manufacturing. And so if China's economy slows down, then that can potentially affect producer prices quite significantly. Now, one important aspect to consider here is that a lot of the slowdown we've seen in China today is not demand side driven, but it's related to structural or longer term factors, like a persistent slowdown in housing construction, or these energy shortages and China's transition more generally away from coal and towards green energy. And so to the extent that the slowdown is supply side driven, then that could actually impact productivity in China and not slow down productivity growth as much as one would expect, again, in a context in which China is slowing down. So just to give you a concrete answer, if you look at our latest global macro perspectives, which is our monthly economic outlook, I believe that we're expecting global producer price inflation of around 11 or 12% this year. We expect that to slow down to around 5% next year, which is obviously a lot less than 11, but still something like 2 times higher than the long-term average over the past 2 decades or so.
All right, thanks, Joaquin. And then our second question we received was, how will weaker growth in China affect demand for forest products?
Yes, so that's obviously an important question as well. Now, if you look at the impact that China has on demand for forest products, the 2 main exports into China are pulp and lumber. On the pulp side, the slowdown in housing will have a direct knock-on effect on specialty papers. Tissue growth, which is the biggest end user, I believe, in China, is a market that is already slowing as per capita consumption in richer coastal areas approach the levels of developed Asia. But I would say to the extent that housing slowdown hits income growth in China, and this is certainly a possibility because of the role played by housing as a store of wealth for Chinese households. If this affects income growth, in particular income growth in less developed inland regions that have a higher upside potential for tissue consumption, this could slow consumption growth further. And then regarding lumber, its main application in China is to reinforce concrete constructions. Imports of lumber in China, if I'm not mistaken, have already fallen sharply this year. They're down something like 30 to 35% so far this year, which is consistent with the slowdown in housing starts that I showed you earlier in the presentation. And so this is clearly a sector that would be highly vulnerable to a disorderly correction in China's real estate market, especially, I would argue, if it forces local governments to cut back not just on lending, but also on infrastructure spending to compensate for declining land sales. And so of those two segments, I'd say probably lumber is the most exposed of this two, just because of its reliance on housing construction directly and China's shift away from housing, from the real estate sector as a major source of growth.
Well, thank you, Joaquin, and I want to thank you for tuning into this month's webcast. As mentioned at the beginning of the session, we have a copy of the slide deck we will share with you later today. Finally, we would also like to offer you a one-on-one meeting with our senior member of our research team, so you can ask any questions about the macro environment and get to know our research process even better. Thank you again for your time, and we hope to see you at next month's webcast. Have a great day.